Welcome to the Uncontested Investing Show, presented by REI Inc. magazine and sponsored by RCN Capital. Each week, we focus on bringing you candid convos from the best in the biz. Here's your host, Tim Harridge.
Welcome back to Uncontested Investing. I'm your host, Tim Harridge. Today, I'm joined by a good friend of mine, Zach Coppinger. Zach, thanks for coming in, man.
Appreciate it. Thanks for having me.
So, Zach, let's just start off. Just tell the audience a little bit about yourself.
I'm 33 years old as of last week. I got my start real estate investing, buying houses for you back in September 2014, a little while ago. Started buying single family houses for you. Ended up going out and doing my own thing. Was that 2014, 2015?
Yeah, something like that.
Pretty much stayed in the single family space since then. Focused on building up a rental portfolio early on. Pivoted in 2018, 19 to focus a little bit more on the owner finance note origination business, but still holding those. Kind of simultaneously built the rental and the note business, and still trying to stay pretty narrow with those two business strategies.
Well, I am proud of you. Zach, I like to start each week with something we call the bottom line up front. Just imagine someone's riding around in their car, they queue up the podcast, they get out, go get gas, and can't find it when they get back in. And in the Marine Corps, when we briefed the generals, they always said, you got don't bury the lead. You lead with the most important thing up front in case you get mortar rounds or something like that. And the briefing has to end. So in 2 minutes, I'm just going to have you talk to the audience and talk about the things that in today's market, in today's economy, in today's real estate cycle, they need to be focused on, they need to be thinking about, they need to do, they may need to avoid. Just take 2 minutes and give them the bottom line up front.
I think today's marketplace over the past maybe year and a half has allowed investors to get pretty lazy with numbers. You could have overbought the house, over-rehabbed the house, gone over budget, and you were fine if you held it for 5 months. You ended up appreciating 10, 15% in that time period. So it allowed investors to get pretty lazy with numbers, right? You keep winning whenever you go into those scenarios long enough, and you start to feel pretty comfortable. You can just keep doing it and keep repeating it. So getting a grasp on your numbers again, having real ARVs, real rehab budgets with updated pricing, with material issues, and even in our personal business, we've seen materials gone up. The contractors have tried not to put their labor up too much because they just they submit a bid. We push back a little bit and say, man, we that used to be 30-40% less. There's going to be a tail in labor pricing going up as well as the material pricing. So I would say with today's marketplace, we're starting to see, I think, a bit of a plateau with numbers in most asset classes as far as pricing in single family. I would say getting a good grasp on the real ARV, the real rehab, not assuming that the market's going to work you out of that. Just because the market's a little bit unknown, it seems very difficult to predict that it's going to keep moving up at the pace that it has been over the past 12 to 18 months. And right in line with that, having a little bit of a cushion in case you miss, right? Liquidity, there's a lot of sayings out there, cash is trash. You're losing money if it's just sitting in your account. Inflation, stated rate might be 7-8%. We feel like it's a little bit more. Losing value on that money just sitting in your account, but it's providing you the platform to not lose your business in case you miss on a deal. So how much liquidity is enough? That's a good question, kind of personal for each person. What we try to do is about 10% of how much money we're borrowing. If we're borrowing $5 million, we try to keep $500K in cash reserves. It's kind of a comfortable position that we found, allows us to float 6 to 8 months of paying out debt service without any money coming in. So to sum it up, I would say have a good grasp on your numbers. Don't think that the market's going to get you out of a sticky situation moving forward, and maintain a comfortable amount of liquidity, and make sure that comfortable amount's calculated. Try to have some kind of basis for why you're doing it. Whether it's just being able to service debt for a certain amount of time if you have no money coming in, being able to go over on your rehabs and still be able to pay your guys and get rid of the property. The property might sell for a little bit less than you anticipated.
Well, that was good stuff, man. There's a lot to unpack there. First question, you're not new in the business by any point of measure, but like you said earlier, you kind of got into it around 13.
Haven't experienced the cycle yet.
It's been up, right? And what do you think is where do you get the information you need to kind of plan for the unknown?
That's a good question.
Yeah, but I know your answer. That's why I'm asking you, because I like it.
So I'm a pretty conservative guy by nature. Backstory a little bit. I started using social media for business purposes about 5-6 years ago. It was just a time suck for me. I spent too much time on there doing things that weren't advantageous for my business. So I started to really network with it, made a bunch of connections, follow people like you. You post some pretty good content. You post a lot of graphic content based on hard data. I try to follow people like you that are, maybe you've experienced some cycles before. I haven't. I've only been in it when it's going up, and it's been going up pretty steep. Easy to get some confidence that you can't lose, right? So I try to play devil's advocate a little bit, and I know it's not going to keep going up and up and up. So the question is, whenever that happens, how do I handle it? And then my dad, he's a CPA. He works pretty heavily in our business. He's super conservative. I'm constantly asking questions, right? I'm saying, hey, here's where our debt service is. Here's how much we borrowed. Compared to cash flow, how do we look? What are your thoughts on kind of the conservative nature and or the liberal nature of what we're doing? Do you feel like we're putting ourselves in a position where we can get a crunch here? Do you feel like we can keep servicing the debt if 20% of our owner finance payees quit paying?
I've always liked that you ask a lot of questions, unless I was in the car with you. But it's one of those things, it's something I do as well. And Jeff Tennyson, one of my good mentors in the finance world, one day he said, dude, what I love about you is you have no problem raising your hand at any table saying, yeah, I have no idea what you're talking about. What do you think? There's a lot of arrogance and ego in this industry. Do you think that's one of your strong suits, like being willing to say, hey, tell me more about that?
Yeah, so a lot of people that know me that we're still good friends, they know that I'm not afraid to ask any question under the sun. My thoughts are, worst thing you can say is, I'm not going to answer the question. No sweat off my back. So people that are in front of me, they've got more hindsight. They've been through cycles. Why wouldn't I ask the question, right? I think there's a certain amount of ego for any type A that's trying to build a business and push it forward. But there's a lot of things I don't know, and I'm more than happy to say, hey, give me some more information there. I'm not going to gloss over and say, yeah, I understand it. And then what happens is I go back to the office, sit there and go, I can't connect those dots. I don't know what's going on. So I stop. And the conversations end up going pretty long because I end up stopping people quite a bit and saying, I need more context. I need more information right there.
It's funny. I was talking with some people that had been doing this business twice as long as me. And although I've been through a cycle, I haven't been through this kind of cycle, right? I went through a financial crash. That was bad. But I didn't go through an inflation-induced cycle. I didn't go through a rising rate cycle. And so, I went through rising, but not doubling in 6 months. So it's been interesting. I'm the same way. I've been asking a lot of questions to people that have been through it. You talked about cash reserves, liquidity. And I liked what you said, and just to build on that a little bit more, it's about the reserves, right? It's about being able to execute your business and looking past that it's devaluing or whatever mindset. Yeah,
so, it's not always going to be rainbows. It's been that way since, 2013 or 14. It's been shooting up. So, I think it's a pretty aggressive position to say I don't need to have these cash reserves because it's losing money. I'm going to put it into projects that are appreciating. I'm going to put it into things that are cash flowing. That's great, but what happens whenever those investments don't become overly liquid? If that's the case, right? And maybe they do stay perfectly liquid, but you're banking kind of your business future on the fact that it's going to keep going up and you're not going to have issues. And there's people that have moved further ahead than I have because they made that bet, and so far it's paid off. But long term, it's kind of one of those things. I've reverse engineered the goal that I want, and I'm on the path that gets me there. Pigs get fat, hogs get slaughtered.
How many houses did you complete last year? New acquisitions?
40, mid-40s.
So somewhere around 40. Talk about what it was like managing the changes in labor and material costs.
I've got a few contractors that I've worked with since 2015 and 16, so we've got good relationships. The pricing's pretty transparent. Said a little bit earlier, materials, the metals, specifically HVAC. We've had 200-300% increases in just certain HVAC materials.
Right.
My contractor's still charging the exact same labor. If you can get them, which there's supply chain issues, but contractors still charging the same labor. So rather than me think, man, I can't afford that pricing, it's gone up 2-3x, I'm looking forward saying it's going to keep going up because there's a lag in labor that's going to have to go up because the cost of living is going up, and they're still getting price increases. So you had to be pretty bad not to make money in the market, even with rising costs on construction. So the numbers still worked, still made good money, went over budget on quite a few things, because if your project takes you 6 months to buy it, execute whatever plan you've got, get on the market, sell it, for a long timeline for a big project, you could have had big price increases that you factored in a certain cost that was still up from prior costs, but they're surging costs that are going all the way up.
So what are you doing different today than say you were doing 12 months ago?
I've rehabbed, I'm guessing 150-ish houses. I'm not the master at kind of honing in on what that exact rehab budget is. I just buy at a strong position, and whatever the rehab comes out to be. Sometimes I hit it on the head, sometimes I'm 15K below. I mean, it's not uncommon for me to miss the rehab budget by a decent amount, but you get strong buying points and you can withstand some of that stuff. So trying to put a really aggressive rehab number on the deal before we buy it. Just making sure that it still papers. Hey, rehab goes up 30% over what we anticipate. And then the ARV, what we actually sell it for, stays flat or even comes down a little bit. Are we still able to get rid of the asset, not lose any money, and move on down the road to the next one?
All right, so we're going to talk more about inflation, labor, being a sponge, being the devil's advocate, and being aggressive in a bit of an uncertain market. Stick around, we'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. I'm Tim Harris. I'm here still with Zach Coppinger. Zach, owner financing.
Yes.
Why?
So, make a long story short, whenever I got into the business, rental properties was where I wanted to be. Right? You get appreciation, depreciation, maintain control of the asset. Something you have forever, pass on to your kids, get a step-up in basis. I mean, awesome tax treatment, right? Built up a portfolio of those, and I'm trying to force myself to really love it. Because it's what I was supposed to do. It's what all the guys in front of me that made all this money, it's what they were doing. And it's a September evening. I'm at the Texas A&M football game at 7 o'clock on a Saturday night. And my portfolio is not huge. We've got about 42 rental properties.
Puts you in the top 5% in the nation, right?
It's on a small portfolio. There's guys that are doing it well, doing it with a lot more properties that were able to enjoy it and manage it better than I was, right? So 42 was supposed to be manageable. We use a third-party management company, but they've got yellow page vendors. You send out the yellow page vendors, your cash flow is just nothing, right? They charge 2-3x what my guys will charge. Right. So they did, the management company did handle the leasing. They handled the maintenance requests as far as the call-ins. We would handle sending our vendors out there. So I'm sitting there at the football game, Saturday night, 7 o'clock. College football season is my favorite sports time of the year. We have, I think, 3 HVAC units go kaput. And then Saturday, in early September, that's 100-something degrees. Right. You can't just say, I'll get to it Sunday, tenants are hot. So there's 100,000 people in the stadium. I can't get any service. I'm sitting there walking around trying to coordinate with the vendor. I just said, this isn't what I signed up for. I'm not sure that I love this. And at that point in time, I had captured quite a bit of equity. So there was the thought of, what should I be doing with this portfolio? I've got equity sitting stagnant. My return on investment to that point was pretty good. The cash flow wasn't great, but return on equity wasn't very good. Wasn't cash flowing very well, and it was just sitting stagnant on the balance sheet. So I had done a few note originations up to that point and compared them side by side. From a cash flow perspective, the owner finance notes were killing the rental properties. and I usually try to stay pretty narrow. I don't want to branch out too far and distract myself from from my investment thesis per se. But then also I realized the properties I was having problems with on the rental standpoint, they were the 1950 builds that were 60, 70 years old. Repairs and maintenance, we were always getting calls for simple things, not, hey, my HVAC's not working. It was, hey, this house is moving like crazy, foundation settlement, door's not shutting, front door won't shut. Something that you can't just go send a quick vendor over to fix. It's kind of having to do with structural issues with the property. Realized that those were some potentially better opportunities to owner finance out. We get typically 30-year paper. The cash flow is pretty defined. You underwrite your borrowers properly, get them to put down a commensurate down payment. Default rates are really, really low. Right. So it allowed for a more stable cash flowing portfolio. Did lose out on appreciation and depreciation, but kind of bought back time. I realized that there was a lot of time being cannibalized with the 42 kind of unit rental portfolio. And I've always been a small operator. I don't have a massive team, got a couple full-time employees. I can build a multi-hundred note portfolio with the team that I have right now. Right. So I buy back time. To do that with rental properties, the team would have to be a heck of a lot bigger. So I think it was a way to buy back time. Now, there are some difficulties whenever you're basically interest income, you're paying the tax man a whole bunch of money. So there's a balance that you can have there of still holding onto properties, getting some depreciation, offsetting that interest income, but I love the cash flow and the consistency of these owner finance notes. Yeah.
Well, I mean, I think, my background. I mean, I've had a lot of notes. I've had no notes. I've got notes now. I'm a believer in diversification, right? So you talked about thesis. What is your investment thesis?
I've been primarily in the single family game. There's a few ways to monetize the single family houses. We wholesale houses to kind of keep money in the marketing budget, right? But it's never been to build out this massive wholesaling company where we've got 5 buyers and 2 dispo guys and 3 lead managers and trying to pump out a couple hundred houses a year. That's never really been the goal. The goal has been to drive enough leads in where we can wholesale, kind of pay the back office, make a little bit of money on top of it, and find really good opportunities for us to put in our portfolio. Right. So it's been to hold properties long term, whether that's with 30-year paper or with rental properties. So it hasn't been to push a lot of paper and be a high volume transactional business. It's been to kind of be a well-rounded real estate investment company with a focus on being able to work for property and have it pay you back over time.
You've always been a deliberate person, and that's a compliment. I'll never forget when I first met you. You said, "Yeah, I'm looking for a place where I can." I don't remember the words. You basically said where I can learn and then go out on my own. And I was like, "Hey, at least he was upfront about it, right?" Like, I mean, and I remember the day that we decided it was time for that. It was like you were ready. You're like, "No, I want to keep this house." And I was like, "No, we're wholesaling." And anyway, I like how deliberate you are, but to what end? What's the Zach Coppinger exit strategy?
Yeah, so I've talked a little bit about staying narrow, right? There's a lot of distractions along the way. Single family, I've reverse engineered that goal of where I can get where I want to go. I've been able to automate some things, hire some staff that has helped take some of that off of my plate. But I've got a bunch of equity sitting in these rental properties, and the equity's a little dead. I can do a cash out refi. I can take that cash out and go do something else. But then I'm doing that. I'm re-levering basically, and I've always been pretty comfortable with lower leverage positions. I don't know that I want to re-lever just to grow. So we're starting to look at some commercial and multifamily opportunities of taking some of that equity and putting that into a new value add deal. So the only juice left to squeeze out of the rental portfolio is additional market appreciation. The value add was done years ago, and we've captured quite a bit of appreciation. So it almost sounds a little counterintuitive. I'm saying stay narrow, but also don't be blind to maybe some new opportunities. Right. And I'm not pulling, even a majority of my attention away from still doing what I do well, which is the single family space. I'm able to do this with a little bit of extra networking and just meeting people. We talked about talking to people earlier. You build up a lot of momentum whenever you start to build your network. Just amazing who you know. Your name gets passed around. The meeting people, the doors opening, the kind of opportunities coming, there's a lot less friction whenever you have been consistent in the business and done things right and people have good things to say about you.
Yeah. John Lee Dumas, one of my favorite podcast hosts, says that you're the average of the 5 people you spend the most time with. And in this business, if you spend too much time with those contractors, the broadness of your mind becomes very narrow quickly. So are you thinking that you'll get into the commercial, the multifamily as like a lead or a deal guy, or you think you're just going to be looking for like syndications, passive investments? How are you considering broadening that?
Yeah, so if I go on the operator side, I've got to take a good portion of my attention and put it on the operator side, and I don't want to do that. I want to build the business. I want to grow, but I've got a 7-month-old daughter. Priorities change a little bit, and I don't want to be. If I can do 40 hours of work a week, like I love working. I don't want to not work, but I also don't want to sell my future working. Right? I got into this to be able to choose to have the freedom to do what I wanted to do, and we talked a little bit about interest income. Right? The owner finance notes spit off a lot of interest income, but it's a definitive income stream, right? It's finite. It doesn't last forever. It declines. So what do I want to do? Do I want to keep originating notes until I'm 50 or 60? And if my life expectancy is 80, these things don't go 30 years. They pay off early. So I've got this earned income over here, right? And there's a segue into these kind of passive syndication positions to be able to put that earned income over there. I'm a real estate professional, so I can get the depreciation benefits. It can offset my interest income. But those are maybe some deals you kind of maintain control of. Now, obviously, as a limited partner, you don't control the deal cycle, but you still own the asset, right? And you have the option to continue to trade into new deals.
Right.
Whereas the notes, once you sell it, you kind of lose control of your destiny.
Right.
Yeah.
It's kind of interesting. Starting last January, so 18 months now, I started investing in passive syndications with people I knew, people I trusted, people I'd watched do business for 10 or 15 years. And it was funny you say that, because my biggest criteria was, the first criteria I looked at was percent of capital available in bonus depreciation. It was like, if I give you $100,000, how much do I get to write off?
Yep.
Because some of the operators, the bonus depreciation would go all the way to the GPs. Like some of them, it was very interesting. So most of the multifamily stuff I did was 80%, about 80% of the capital to depreciation ratio. And the commercial stuff I did was 60 to 70. But I like knowing that I own a piece of a JP Morgan Chase building in Kansas City, and 8 apartment complexes spread out in Dallas Fort Worth, and a deal in Houston. And so I hear you, and it has, I feel a little bit more secure that someone else has to put up with the headache, and that I've got reporting, I've got ownership, but the tax benefits have been good.
There's the saying, don't let the tax tail wag the dog.
Yeah.
It's one I try to balance quite a bit, but you look at investment. If you're a real estate professional, you can get your bonus depreciation. You put in $100,000, she's rough numbers. Let's say you get $80,000 in depreciation out of it the first year. Your effective tax rate, she's round numbers, 40%. That's money saved that you can put into another deal. So there's opportunity cost of that money that you're saving as well. You don't let the tax tail wag the dog, but know what the tax consequences are and use them to your benefit, right? Starts to sunset next year. I think we go down 20%, or we get 80% bonus next year, and then 60. Depends on if it renews, but half of the battle is just having the knowledge or the network to be in the circles where they're talking about it.
You asked about that. You mentioned that earlier. Being in the network and having the courage to talk about it. Talk about curiosity and your networking strategy, and kind of how that's helped you through your career.
I'm pretty calculated in a number of things. Networking honestly hadn't been one of them. Rub shoulders. I go to some networking events. I don't really go to that many. I started to use social media as a kind of as a tool for the networking piece. I've met a lot of people through Facebook that I'm now personal friends with. I'm kind of in person, but they all started kind of online. I've never been the guy to post a check or that kind of flashy thing. So I've always gravitated towards people just talking about what they're doing, not showing me what they're doing based on posting things that are a little flamboyant, but just talking about what they're doing. Right? So I'd connect with them. I do make it a point to get a couple new relationships a year that I kind of pour into me. I don't really value numbers. I kind of value quality. So I've got a decently small circle. But something I think that has served me really well in building that network is any problem I've encountered in my business, I haven't questioned who I call to get the answer. I think it's really invaluable, and it's something I just thought about a year ago. Someone asked me, hey, you seem to be really good at solving problems. So I don't know that I'm that good at solving problems. I've always got questions. And what I found out I was good at was knowing who to call if I had the problem that needed to be solved.
So I have made a very good living out of knowing a guy. I know a guy. And I get people that pay me to be their consultant just because I know people. So, and Gunnery Sergeant Luster told me one time, he said, the old, it's not what you know, it's who you know. And it never rang true more than the time that I was in a place that we weren't really at, and I had to pick up the phone and call Headquarters Marine Corps for some stuff we needed, and guess who answers the phone? Gunny Luster. So I hear you, and I admire that about you. And when we get back, we're going to do the Money Minute and then Rapid Fire. So stick around, we'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-vest.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. I'm Tim Harridge. I'm still here with Zach Coppinger. Zach, it is time for the Money Minute. So imagine there's an entrepreneur out there, a real estate investor, a young man like yourself that is looking to get in the business, and they're only going to get 60 seconds of advice all month long. And that's the Money Minute. You've got to you pour into them, tell them what you need them to hear that's going to change their business and make them more money in their business. You ready?
Yep.
Go.
I would say stay narrow. There's a lot of distractions in social media, people doing a lot of big things, a lot of big deals. The flash isn't usually consistent, right? So stay really narrow with what you want to do, and then reverse engineer the goal. If you want to stay in the single family space, you want to originate notes, figure out how many notes you need to originate to kind of live the lifestyle that you want, and just work backwards. If you just at the base of the mountain staring up, it looks so tall you don't know where to go. If you look at just figure out where you want to be and have incremental steps working backwards and start accomplishing those steps one by one, and you end up where you want to be. You don't have to worry about getting up at the top all at once, but you know what your measured progress is and how quickly you can get there, and that provides you the lifestyle that you want based on the goal that you've already put out there. So don't get distracted by what other people are doing. Stay narrow. Don't get distracted by the big business opportunity over here that takes away from what you're already doing that you know gets you where you want to go. If you know that it gets you where you want to go, just stay on that course.
That was good stuff. And it's funny, in the military, we always used reverse planning, right? And so D-Day was D-Day. Well, D-1, right, was the boats had to be in a certain position. And D-5, they needed to be in a certain position. And D-20, they needed to be loaded, right? And so D-50, you needed to have the supplies ordered. And it's, I tell people all the time, it's just like start with the ending goal in mind and work backwards and then hit those steps. So we're going to do some rapid fire, Zach. When I first met you, you had met a gentleman by the name of David Phelps, and he told you to call me. How did you meet David? Why did you meet him? And what did you ask for?
My mother-in-law knew David Phelps from church. She kind of made the introduction, as well as I guess my neighbor knew David Phelps. So I had 2 points of contact. Reached out to David. He kind of extended a job offer to me, knowing I wanted to get in real estate, and then retracted the offer, said I was a little too much work. He didn't have enough time. He said this guy named Tim might. So reached out to you. You were actually moving that weekend. I don't know if you remember that. You were moving, and you didn't answer my call. I called again, and I ended up sitting in your office for maybe a few hours, and I don't think we talked that much. I think you were pretty busy. And then before I left, you kind of extended me. You thought I had some patience. I'd called you a few times, at least a little bit of persistence. Maybe I looked the part. I had a decently clean cut, wore a pair of boots and some jeans, and rest is history.
Yeah, so, I mean, you know a guy. How important has your reputation been in this industry?
It's something that I've paid quite a bit of attention to. I talked about it a little bit earlier. The network builds whenever people don't have something bad to say about you. They know what you do, and whenever you get tossed around in conversations, they never hear, that Zach guy's super sharp, but, we were on a deal together and he kind of, I disagree with what he did, right? So I've always felt really confident in the decisions that I've made and how I've treated people. It doesn't mean that everyone always agrees with kind of what I do, but I think there's a certain level of respect for always thinking a little bit forward of, hey, I think this is the right way to do it, and this is what I'm going to do.
Talk about treating your vendors the right way.
As far as subcontractors go, anyone that you're doing business with, pay them. Pay them on time. Don't make them chase you down, right? I get quite a bit from my vendors as far as quality service.
Vendors. Zach, you mentioned that you've had some of the same vendors like for 7-8 years now. Talk about how you treat your vendors.
Yeah, so I'd say transparency, but also, if they submit a bill, pay it on time. Don't make them chase you for money. It's not that hard, right? Make sure that you've always got the money for the guys. Don't ask them to go do work hoping that you're going to get the money to pay off from another job to go pay them. Don't have someone do the work if you can't pay them. And whenever they actually get the work done and get it done right, pay them, and develop some relationships with them. I know the guys. I know how many kids they have. I know their kids' names. I know kind of what they do with their time. And then whenever you've got that emergency, you got a house that gets broken into on a Sunday and the neighbor calls and says, hey, you got a vacant, the door's kicked in, and I can call the guy and there's a good chance he's going to go out there for me.
Right.
He takes care of me, but I also try to take care of him.
Right, it's mutual.
Yeah.
It's funny you said earlier, yellow page vendors. What have been some good ways to find good vendors you found?
Talking to people.
Talking to people.
Yeah, talking to people.
This is that's going to be the name of the show, talking to people.
Talking to people.
Capital Stack. You are from the second most wealthy family in the world, and they just gave you all the money you needed to buy all these houses, right?
Okay.
No. Is that your background?
No.
How does one go from college graduate to owning 40 rentals in 10 years?
Okay.
And what are some of the money or capitalization strategies you've used that have helped you along the way?
So my wife and I got married, did the whole dinks, double income, no kids. My wife, she was making $40,000, $42,000 a year in 2015. So it's not like she was making a ton of money. I started the business, roughly that 2014 timeline. Didn't have a whole lot of money to start it, but didn't take a penny from the business. Lived in a really modest condo, paid $1,300 a month, $1,400 a month for rent. Lived way below our means. She kind of paid for us to just cover our expenses, and everything that I made in the business, which was a decent amount of wholesaling at the time, just kept rolling it in. Lived in that condo until 2021. So, some certain life circumstances caused some forced altruism. We ended up not being able to conceive a kid for a while, but we just lived below our means, right? And then wholesaled, built up some capital, and then started keeping deals as soon as I could. Didn't say I need to wholesale 50 until I keep a deal. I wholesaled a few and I kept a deal. Wholesaled a few and I kept a deal. Wholesaled a few and I kept a deal. Started doing that with private money. Once I had a stabilized asset, like a rental property that was occupied, it's a lot easier to take that to the bank and rate and term refi a stabilized asset than it was, it's something that didn't have a tenant in it that you were trying to get stabilized. And even further, private money, it's not that hard of a sell to go to somebody and say, hey, this house is worth 100. I want you to loan me 70, and I'll pay you 8 to 10%. There's a lot of money sitting on the sidelines wanting something they can put their money into. You don't have to be from a super rich family to go find a little bit of private money on the sidelines, whether it's someone that's got a self-directed retirement account or just cash sitting. Guys want to de-risk as they get older. They don't want to be in the stock market. They want something stable. So how far do values have to fall to loan 70 on a 100K asset, even if the operator's an idiot?
Farther than they ever have. Crystal ball. Is there a crash coming?
Real estate value specifically what I'm going to talk about.
Real estate value?
I don't think so.
No.
Decline, plateau, maybe a tiny bit, but we don't have a mortgage crisis on our hands.
Interest rates still going up, or are they plateauing?
Going up.
Going up. Let's see. So, Zach, you have made a career out of talking to people, networking with people, meeting people, but you also say you have a small circle. Any advice on that as we kind of wrap up?
It aligns with my mindset of kind of staying narrow. I'm not trying to have surface relationships with everybody in the industry where everybody knows my name. Try to develop some pretty strong relationships where they're going to give me the good stuff if I call. They're not worried about me being competition because the sum of us together is more than us being individual, right? So I do know quite a few people, but I don't know a lot of people extremely well. I've got a decently small nucleus of guys that I spend a good amount of time with, and we talk on a pretty regular basis about what's going on in the market, what we're doing to kind of capitalize on the opportunities and asking each other questions whenever we don't know the answers.
Yeah, I think there's so much power in that. Nobody knows everything, and everyone knows something, right? Mm-hmm. So, parting thoughts, parting shots?
Cash is not trash. Keep it, even if it's losing a little bit of value to inflation. Don't think that you don't need it, because by the time you need it, it's too late.
Yeah, that's really good advice. Whether one predicts a market up or down, even in the up time frame, you have to have good footing. Liquidity is important, and these are liquid assets to some degree, like you said, until they're not.
And realize my prediction is values don't go down. So I'm not saying a crash is coming, hoard your cash.
Right.
I don't think values really go down. I think it's still prudent to keep some cash reserves because, like I said, by the time you need them, it's way too late.
So, Zach, if someone wanted to connect with you, do business with you, network with you, where do I send them?
Facebook. I'm not a big LinkedIn guy, not a big Instagram guy. Don't even have a TikTok. So Zach Coppinger on Facebook. I'm on there quite a bit. Connect with me. Send me a message. Happy to connect.
And goodbyehomes.com.
Yes, goodbyehomes.com.
Well, Zach, thanks for being here, man.
Appreciate it. Thanks for having me.
Yeah, so you've been listening to the Uncontested Investing Show. Remember, your network is your net worth, and today you've been growing both. We'll see you next time.
Thank you for listening to the Uncontested Investing Show. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time. The preceding program is furnished by RCN Capital LLC. The information provided is for general education purposes only and does not constitute any legal, financial, investment, or other professional advice. The views, thoughts, and opinions expressed of any speaker are the speaker's own opinion and do not represent the views, thoughts, and opinions of RCN Capital LLC. No information contained in this episode should be construed as financial, investment, or legal advice from RCN or any individual, author, host, or guest. You should always consult a financial advisor before investing.